This is Justin Pulitzer. This is my weekend review video for Sunday, November 6th, 2016. Heck of a lot to cover. I'm going to start out in the macro, get into my 7 market keys, talk about the major market indices, hit up some of the Momo stocks, and then talk about some of the Silliness stocks to close, and the lessons that we can take away from those. Anyhow, we had a jobs number. The prior 2 readings were revised up, which kind of cushioned the big miss that this jobs number had. What was hidden inside of this jobs number, though, is something I've been discussing with you guys and gals for a while, and that is that companies are moving away from full-time positions and moving more toward part-time hires. I believe it was something like losing 103,000 jobs and gaining 90,000 part-time. It was good that the average hourly wages have been growing a little bit, and I know everyone's very excited about that, and they think that the Fed needs to slam on the brakes to stop inflation, but keep in mind that these numbers are relatively low. They're near 15-year lows, and we're not talking about high-quality jobs. I often joke around, and I do this just because of not because that I don't care and that I don't take it seriously, but I just think that the numbers that we're being fed and being told by the media are just so ridiculous. And I often talk about the carnival ride operators or the mall Santas and elves or the back page special. And I'll just tell you, I anecdotally, I've lived in New York City my entire life, and I don't think I've ever seen as many homeless people on the subways or under highway underpasses and so on and so forth. And we have a mind of our own. We lost the economic calendar. Anyway, the economy is not doing well. The jobs, the quality, the wages, it's not there. Healthcare costs are rising. The cost of living in terms of property is going up, but you're not seeing a lot of inflation in terms of pricing. And I think a lot of that has to do with technology. One of my big themes is AI and automation, and I'm going to update that to advanced automation, and I think that is going to be keeping wage pressures lower for longer and wage pressure, as well as the cost of technology. I mean, think about the what people buy in the economy these days, computers. I remember years ago in the 90s, I would buy, let's say, a Dell computer. It would be a few grand. Right now, I mean, you can get like something that's absolutely amazing, not necessarily have to be the top of the line, but even for well under $1,000, in many cases a few hundred, with Apple computers being the exception. But some of the PC clones, that's a old term. I'm sort of showing my age, but the PC clones are all pretty cheap. So that's what's going on in the state of the economy. Anyway, let's talk FOMC. I've said for a while the probability of a Fed hike is unfortunately likely in December. The data is not supportive of a Fed rate hike. The GDP is relatively low. I just outlined the jobs pictures. Things are not great, but I think the Fed may want to, quote-unquote, save face. They raised last December. They had talked about raising 4 times this year, and I feel like they may do it more for ego purposes than reality. These are ivory tower people, academics, and I will tell you they're a lot more competent than people give them credit for. They do follow quite a bit of data. They really do follow the markets quite closely. If you ever read the Fed minutes, I mean, these are like the new hot novels. I mean, I treat the Fed minutes like let's say the new Harry Potter book. I actually read them pretty much cover to cover, and they do follow the markets, and they are quite deliberate with their statements, and they like to test and see market reactions to things. I don't necessarily know that this number is going to stay up this high, depending on what the outcome of our election is and some of the data that comes in. But I will still say that I'm still in the camp that they are likely to go in December. They should not go in December, but I think that they are still potentially likely to go in December. So that covers it. Again, shouldn't go, but likely will go. Anyway, that has not been going over well in the market. You can see we're starting to get some volatility coming back into the picture here. You can see we're making, like this period of time, some higher highs off some higher lows. We haven't broken back into that old potential new up channel, but we may have to start redrawing this as need be. There's some good news and there's some bad news with the volatility. Let's start out with the bad news. The bad news is that we are making some higher lows and we are starting to make some higher highs on a absolute and relative basis. The good news is we're still sort of not breaking out fully in terms of volatility to the upside. This did close slightly above the downtrend line and back into the channel, which is troubling. That could mean we retest these highs, and I mean, in a really extreme circumstance, we could even come back up into the 30s. So a lot of people are comparing what happened with what's happening now with our election to Brexit. They are actually diametrically opposed, and I will discuss. While the movements are very similar, the setups are very different. In that case, the market had rallied very strongly, and IV had been crushed into the Brexit decision, which wound up going a way that people didn't anticipate. It really only lasted 2 days, and then within a week, we were basically at new highs. The situation here is that the markets are falling precipitously and volatility is rising, so you can't really call an event a black swan event if people are afraid of it and anticipating it. That sort of goes against the old Monty Python boy said nobody expects the Spanish Inquisition. In this case, people are anticipating a Spanish Inquisition. Again, possibly dating myself a little bit. Anyway, with regard to volatility, we didn't close above 25, which I think kind of takes a little bit of the quote-unquote crash risk off the table. On Fridays when we closed, like this was the example of the flash crash, when we closed above 25, it got real iffy. Here, we didn't close above. We looked above and failed, and then it came back down. So I do think that there is some potentially a little bit more bounce fee or ounce. I used that term in an interview recently with regard to gold and silver, but there might be a little bit more upward pressure in volatility going into the election, and I do expect that volatility to recede into after the results. Sort of, it'll be the sell the rumor, maybe buy the news. I'm expecting some kind of a relief on election results, assuming we continue down into it. If we rally or have a relief rally ahead of that, like tomorrow, that would not be good as far as setups go. So VIX coming into some of the major resistances here, and I'm expecting possibly a little bit higher, but then I'm expecting this to recede. I know a lot of people are short. I know they've been pressing shorts all week. The market basically has been down, I think, for like 7 days. We'll do a count when we get to SPY, but multiple days down, getting oversold short term. There's potentially a little bit more down there as well, but we'll get to that when we do get to that. The dollar. The dollar is actually cooperating a little bit. This has been coming back down. We hit a channel high. We had a bit of a look above and fail. We're coming down. We didn't even quite get range high, and kind of coming down to test maybe some of these breakout areas near the 50 and 200-day moving averages. So the story with the dollar is this, and I know this is going to be counterintuitive, but I assure you that this is really the proper way to think about this. As the dollar rises into the Fed decision, it makes the Fed less likely to hike. Traders will think a hike is more imminent because the dollar is rising, so of course that means the Fed must hike. But as it gets higher, that makes the Fed more worried about a hike because that would exacerbate the problem. As much as they may talk about wanting to have a strong dollar, they do not. We have trade deficits in this country. We are very weak as far as our growth in GDP, and this will exacerbate the problem tremendously. As this recedes and comes back in, that actually could make a Fed hike more likely traders would say the opposite, that the dollar is falling. But that would give the Fed a little bit more cover without having to worry about the dollar pressure. So the fact that this is peaking and coming in isn't necessarily that comforting to me. It might be kind of peaking. White Rabbit might be peaking too soon. Little fear and loathing reference there. Anyway, we're coming in. We have some supports a bit lower, so I do think that the dollar could come down more, but I wouldn't get too cray-cray just yet. We do have 50, 200, and 100-day moving average support, as well as this breakout here around the 2487-ish level around here. So that's my take on the dollar. The bonds. There's some good news and some bad news with regard to the bonds. We are still way above the 2009 crash peak. I want to show, as dramatic as this kind of downturn has been, and we've kind of seen these before where we've had relative fall out of bed kind of moves. If you take a look, this was the end of the world, right? 2009, the peak of the financial crisis. We were up here again, came down. We got close to the channel high again here, not quite getting there, and now receding back. I'm going to discuss some things I'm noticing. First and foremost is that we're coming into some key supports a little bit lower. If that were to fail, and like we do get we have a trend within a channel, so this all kind of coincides, so I don't necessarily know if we're going to completely fall apart and test the channel low, which would coincide with this low down here in the 114s, 115s. On a more immediate term basis, I like to think big picture. I like to think big, and then I also like to think small. I like to kind of look at things on multiple time frames. You can see these were the reference lows down here. If you draw a Fibonacci retracement, the 61.8 and kind of like this breakout level is around the 125.86 level. The trend is kind of close to there in the 127s. You have these reference gap areas down there, and you've precipitously come off the high. So I'm thinking this area here could be a interesting area if this continues to fall. I'd be interested in selling some right or right out, near dated out of the money puts. I don't know how much juice they would have, but I would probably be looking to sell something in the 121s down to the 115s, depending on your time horizon. Maybe even some at the money puts if we kind of came down there like quick. So bonds, like I said, the market has been up because for a while now I've said because of PE multiple premiums. As interest rates rise, the PE multiple that we're willing to pay for stocks with vastly diminished earnings becomes less. So that's the reason why this has been weighing on the markets, and I'll propose that it's more related to this than it is even to the election. HYG, some food for thought. So a funny thing happened on my way to the options market. I was looking at the put situation here on HYG. I actually got a notice in Trade Flash, and I was noticing people are loading up on these puts. That means that people are sort of trying to front run or anticipate a financial crisis. There's some the put activity on this kind of is making that thesis, but there are some other things that are going to dispel that, and I'm going to talk about that in a minute. I think that this move here was more technical, that the back off, like, look, if we came down pretty hard. We got up to the 61.8 Fibonacci retracement. This was the edge of a big volume distribution here. You can see before this one, this was the separator. This was really the meat of the move. Look where the breakdown really took place from. I mean, you came out a little bit of a look above and then kind of came down. So all these people that were long over in this area, with these kind of attempts, I think are just taking their money back. We've been down multiple days in a row. We filled the gap. Something I noticed I think would be an interesting on a bounce maybe is the 84.80 put spread. Why would that interest me? Because when you fail at a 61.8, just technically speaking, sometimes traders like to take it down to a 61.8. So if you bought the 84, and this is basically 80, 79 put spread, you basically can put that on for $1 or maybe even less into a bounce, and you're risking $1 to make $4, and that would be I believe, in January expiration. These puts all in this region here are getting a lot of volume. So it seems to me like people are anticipating a down move. But the good news is when people are that heavily short, they will have to eventually cover. The kind of this time is maybe a little bit different. Here the 200-day was downsloping and was a heck of a lot of resistance. We couldn't even get to it in many instances. Here we broke out, retested, held it again. It's been a while since a retest. We're forming a kind of a rounded bottom in the 200 MA. So I think that there could be a little bit more, there's a gap fill down here. Sometimes the 200-day doesn't always hold to the tick. There's a little push through, as you can see here. So it wouldn't surprise me to see a little bit more move down in the HYG. It's a little maybe late to first start shorting outright, but on a bounce, maybe. So I'm thinking a little lower in the HYG, but could be coming into some short-term support. And I do like that 84-80 put ratio for a pullback. It could also be portfolio protection. So what are the economic things that I'm seeing that don't jive with this scenario? The first and foremost one is copper, Dr. Copper. This is seen as as a thermometer, if you will, a temperature taker for the overall economy. Dr. Copper, as the market has been coming down, has been in rally mode. That doesn't jive with a recession or major correction. You can see the 200 MA here. It was really very hard to spend time over it. That is also starting to turn. We are coming to the high of the range of copper, basically coming up from the bottom. So I don't necessarily know about completely chasing copper here, although I do like it for buy the dip type of scenario near this confluence of moving averages. You can see you have a bundling of them down here. The 200 and the 100 and the 50 are all pretty close down in the 24s. So if there were to be some kind of a pullback mid-range, I like it for buy the dip. But this isn't jiving with a bad economy or credit crisis type of scenario. Actually, quite the opposite. The other one, and I don't want to get too perverse because we are a family show here, right, is the trannies. And I don't mean about the old meatpacking district type of trannies. I mean the transportation index. We are still in a downtrend, but take a look at what this looks like it's forming. Potential inverse head and shoulders with a higher right shoulder and basically coming right into multiple tests into a neckline. So the transports aren't exactly, I mean, as the market came down this week, the trannies basically finished near their highs. So for a bad economy, you really need this to, and we're above the 61A to the pullback range. I could always draw another Fibonacci retracement, and maybe I'll do that. I don't like what this might have been used for a extension drawing at some time, but let's draw that in now. Fibonacci retracement. If we do the absolute move, this isn't snapping so well. Alrighty, 167.2. We don't need the 38.2. So you can see we're coming into some big levels here. I like to turn these red when we're coming from the wrong side. So this is some big decision points here. We've spent a lot of time just below it. So I don't necessarily know that the 61.8 is going to be as much resistance as it might be if we kind of came up straight to it. Then I think we'd back off more because now we're kind of just... my buddy Peter uses the term bubbling under, so we're kind of bubbling under the this area. So, yeah, we could have some resistance coming up into the downtrend, and that would be up into this area. But there is some room for the trannies. FedEx, in particular, this is kind of the one I've been watching, has been holding up rock solidly strong. Also, inverse head and shoulders already had the neckline breakout. A kind of successful retest. This was a bit of a look below and fail, and now we're still above the gap. So, again, nothing that this to me bodes better for maybe for a decent holiday season. I mean, you could see you have multiple actually inverse head and shoulders here. You have the bigger picture one, kind of like this, and you have the one inside. So, this to me is a fairly bullish pattern. As long as this holds the 50 MA. I like it long. I actually have a small long position on in here just because this to me looked professional gapish. I like when there's a successful retest. So we'll see how that plays. We'll see how that plays out. But these are just things, Easter eggs that I look for in the market. Oil is not behaving as well as it maybe should. I think the word is out now that the Saudis, There's no consensus. Iran is kind of playing hard, although I read some info over the weekend now that they might be more close to a deal than people may have thought. There's some good news and some bad news in oil here. The best news is that it's come down hard and fast. The bad news is it has come down hard and fast. I know that sounds kind of cray, but it's oversold short term. You can see we're into oversold areas in the money flow index. We're not quite there in the stochastics yet, but you have some reference lows here. You have an upwardly sloping 200 MA here. The old kind of resistance, which should now be support. We did break a downtrend, which is not good, but often what you have is you have the initial break of the downtrend, kind of a throwback retest, which we have not had, and then can perceivably a resumption down. I just took the liberty of drawing these in. They're a little bit arbitrary. This one isn't arbitrary, but this one is a little bit arbitrary, just saying maybe we would throw back up into this area, and then, because this really should have been the support, and then maybe it would resume down, but oil short-term is getting a little bit oversold. Oversold can get more oversold. I mean, this could easily get into these Fibonacci numbers if they don't cut. I mean, we noticed on Friday the Baker Hughes rig count was up again. I think this was really just a function of coming back up into reference highs, and maybe we're just forming a range now, which 39.40-ish seems to be the absolute reference low. So I'm expecting some support here between the 50% fib and this 42.49. So yeah, I'm thinking oil maybe a smidge down more, but I think it's going to start catching its sea leg soon, and if that happens, it would start being better for the market. Exxon reported some numbers that weren't so stellar. You have a trend line coming in soon, a 61.8 around 81s. This is going to be really key. If you lose that, 77s could be in play, but this area to me seems like it could be forming a double bottom. And I like the idea of starting to initiate Exxon positions by selling some out-of-the-money puts into that area. Chevron has been kind of holding strong, although we are still consolidating inside of a range. It is still holding trend. I like if this were to pull back for any reason into the 200, you can see, look, this is where the breakdown took place from. Resistance here, resistance here. It broke out. It has never really retested the 200. I think that's by the edge of this distribution. You'll have trend 50 MA. I like Chevron now on pullbacks, so that's my thinking for right or right out trades. I mean, if it were to lose it, this could come back down to the real breakout in 88s and this volume distribution rather quickly. So we're talking about right or right out type of action, maybe same week or next week expiration in puts or even shares. FXI is at a decision point. We are below this kind of reference breakout area. I probably can get rid of that. It's not as important as it might have been in the past. But we are basically on the channel low. I had discussed that I thought we would see the channel low in the 100 MA. A little bit below the 100 MA, but we'll see. This is very key. If we were to lose this channel, remember what I've said for a while. When we lose 50s, we see hundreds, and if we lose hundreds, we see 200s. That's sort of my theme. By the way, in that theme is if we hold hundreds, we re-see 50s. So we're taking it from one moving average to the next. The good news, again, is the 200 is now upward sloping. Unfortunately, we're a long way from Kansas Toto. If we were to lose this, the 200 and the 50 MA are a kind of a country mile below. So I'm a little careful here. I don't mind playing right or right out, but this needs to be really right or right out, because if this were to dump, we could be into a world of hurt for a while. Oddly, this would stay the Fed's hand a little bit, because when they talk about foreign risk getting better or worse, China rolling over is making it get worse. So oddly, as bad as this might be, it might be good for keeping the Fed on hold. You can see that this 50% fib is roughly around here. If this were to snap and come into here, I'd be interested in selling some out-of-the-money puts in the FXI. Getting out of BABA turned out to be prescient or however the hell you want to pronounce it. We were Audi 5000, roughly getting close to the 110s. I actually got a fill basically at the high. I had the basically the options to time out at 110. It got 109.76, but I guess the way it got there, the IV was pumped up enough, and I had kept the short puts on, and I'd closed them somewhere in here just because I didn't want to be really in the soup for earnings. We are below the 98.45. We're below this breakout. This breakout here to me is the key, because look where this fell apart from. This was kind of the earnings pop resistance, 98.86, 98.45. This was the bounce was a look above and fail. This could easily come down to the 100 MA. I like right or right out on the 100 MA just because this has come down so far and so fast. But if this continues, I mean, this could easily fill the gap, I mean, and get down to the 87s or even 84s. And it's not like we haven't seen that kind of cray-cray action in the BABA before. That also coincides with trend line. So if that FXI breaks and dumps, BABA could actually be the short to play for the gap fill. So I like put ratios. I like put spreads. I like outright shorts if you want to play maybe versus this area, maybe with a 98.79 was the high here, so maybe use like a 99 stop, or a right or right out if this were to bounce to the 50. But this to me, stocks that can't go, they had great earnings, by the way. BABA really kind of crushed it. The theme lately, though, has been stocks that have good earnings pop and then flop, and then stocks that miss get absolutely eviscerated. So I'm thinking this might have a little bit more room down to the 100 MA, but I'll like the idea if we get to the 100 MA and these kind of references, maybe selling, starting a smaller position, selling some out of the money puts here. You have the 200 kind of coming up. You can see that was support the last few times. So maybe sell some small here, and if this continues, then sell some even more to bring the position up to full size, maybe like those 78s. As the IV continues, IBB getting close to the range low, coming down from the top, coming to the range low. I don't know how many times this can get banged on and continue to hold. My guess is it would come down, get maybe a small bounce, but maybe roll over. The reference low is 107.48. If you do a Fibonacci extension, I think it was off this range that I did it, that would take you down to the 212s, 207s. Maybe if Queen Hillary gets elected, we get the full articulation lower. Oversold on the stochastics, a bit oversold down here in terms of the money flow. These are getting to be diametrically opposite. So I'm thinking that we might catch a right or right out trade here. The ideal scenario here really would be like a look below, run the stops and fail, and then push back up into maybe the mid-range. But I'm starting to get a little bit more interested as we kind of near this like last leg of maybe the long-term move lower in this this IBB. We can see we could snap the trend. It's coming down. I think a lot of people will assume this automatically snaps, but again, when we come down, like the same thing here, when we come down from the top, there's a bounce. Maybe it does the same thing again. I'm thinking it might not hold this time, but I do like the idea of put spreads or ratios, buying one like around the 240 and selling like 2 times out of the money here or somewhere in between, because I do think that this area is going to be, this is basically 100% retracement of this, and I do think that this area would be some support. SPY. All right, let's zoom in here. This is going to be, we're going to start getting into some real wild technical kung fu here. All right, so we had a channel snap. We had kind of we broke, got back above, and now below. I realize that there is a lot of drawn in levels here. Just try to bear with me. If you stay where my pointer is, we will weather this storm together. Let's zoom in. So I told you guys in the last couple of videos that I've been expecting a move lower, that I thought below the 50 MA remained vulnerable, and that I thought we could double the range. This was a $7.29 move from this peak to this low, and if you projected that lower, that would roughly take you down into the 205s. We had the Yellen breakout at 205 quarter. There's an old range reference support in the 206s, and that coincides with the 61.8 of the entire range, which is currently at 206.65. So what does that mean for us? Also, one more point of order. This was Brexit. Notice that they had rallied the market fairly strong into resistance ahead of Brexit. The market is coming down into the potential into our election, and here we were rallying. This, I don't know if it doesn't look as extreme, but this was a very extreme overbought situation that day. It was basically like a huge spike up, particularly late in the day, and then it dumped hard for like a couple of days, and then came back up very quickly. So I'm thinking that we might have a little bit more down in the market, but maybe not so much. I'll show you some levels that I think are important. So, keeping with my theme, couldn't hold a 50, we got a hundo. Couldn't hold the hundo, we got the 2 hundo. We're on a less steep channel low. The steep channel low would take you roughly around the 61.8. You can see we've had instances where we've punched through the 200 for a little bit. We may punch through again. This is really the tail line of support for me. The expected move in SPY this week is $6.94 roughly. That would take you around to like the 2 up. If we got up, that would take you back up to like the 215s, which was basically would basically be a 50 MA test and a channel high test. Don't rule that out. That's rarely very possible, believe it or not, if there's a relief rally. If we were to dump, that would take us down to roughly 201s. That is basically filling up the gap from this entire move. We'd basically be round tripping. I don't know that we're going to get that entire move because I think, as I proposed, I think volatility is going to contract. You know, I often say when the market is at highs, I take the expected move to the upside. Or like, let's say it's IV is really low. I think that the expected move to the upside is sort of the limit, but the downside has more potential. Now that IV is high, I think that the risk is now for maybe a volatility contraction and that the move would shrink. So I'm thinking we may go a little bit lower. Listen, we could hold the 200 MA and this could kind of be it. We got a gap fill. We're at a 50% fib, 200 channel low. This could be kind of it. I think we may press a little bit lower. The 61.8, I want to show you on a bigger time horizon. The Yellen Religion Day, this is that high. This was that day. So we're getting kind of close to that band, and that this would be that measured move-ish area. So I'm thinking like 205s and 206s are key. The fact, though, that we are below the 210 to like 209.53 to the 211 area has me a little bit iffy. This could be poor lows and we could have a move back up, but until we're back firmly above 210 to 11, I still favor the downside. If we could get back up over 210 to 11, the market should start firming. On an extreme move here, we could fill this gap to the 203s. So, not to as we get more volatile, I think somewhere between 206s and 203s is going to be it for this leg lower. Measured move-wise, Brexit measured move-wise, double the range move-wise, a technical move-wise, that area seems to me like going to be key. We're getting close to oversold. We're oversold in the money flow index. We're getting close to it in the stochastics, as well as the higher high, lower low kind of index that I've recently been futzing around with. So I'm thinking somewhere in these next few points between the 203s and 206s will be the end of this move for a little while. Okay? Let's go back to, and we're frozen, which is never comforting. I just look, there's a lot of congestion here. I want to show you I just want to finish this up with one last thing. The volume distribution wise, maybe we go a little longer. Let's go 10-year weekly. I want to show you something else that's really interesting. You can see that's where this distribution ends, down in the 195. So that would be, I don't want to show 195s for a minute because I'm not really considering that just yet. Also on the weekly, the 50-week MA is right at the 61.8 at the 206s. The 50-week MA, by the way, is very key. Look at this. When we lost it here, that's when we got the big dump. We spent a lot of time trying to get over it, and when it failed here these few times, that's when this dumped again. We got back up here. We spent some time. It finally supported. Here again, it was a look below and fail. This really needs to hold. This 50-week MA, look at this also reference price zone. This is where the rubber meets the road in my view. I'm okay with a little bit of dangling stuff below there, but not much. This 205 to 206 area really, really needs to hold. I don't want to freak anyone out, but if we go back into our Wayback Machine, this is the 2008 crash. Look what happened. We lost the 50. We had a very significant rally, stalled right at the 50, and that's when the shit hit the fan. And I don't mean to be crass, but that is what happened. So yeah, these are the key levels in the very short term. Somewhere in this range, the 203s to 206s really must hold, but if we don't hold the 206s, I'm going to get even more decidedly cautious on the market. Let's go to IWM. All right, so let's get a little more short-dated. My IWM chart, I don't think it is kind of messy. These are the actual charts I use. I'm not one of these guys that, I actually trade. This is what I do. Broke the channel. I remember I said this was a right or right out short when we snapped the 220.58 level. This low was 119.88. Lost it. Came down to the 61.8. Remember what I said, that we got basically kind of close to the upper end of this range. I thought we could articulate down to the lower end of the box. 114.29, 61.8 is 114.95. The 200 MA is 114.41. This area should hold, and it kind of is. If we were to lose this, there is a gap fill down around the 110s. You have a the 78.6. So if we were to lose this, and we did get down to the 110s, I would be interested, just because we had rotated so far so fast, filled the gap, basically 100%ed it. I'd be interested in selling some out of the money 105s, 106s. That's the 61.8 of the entire range. You can see 103s. This area, if we get down to the 110s, I'm interested in selling 106s or 103 out of the money near dated puts. I think that we would have really gotten oversold, and those would work. But this area is really key. We are basically sitting on the key of support. So if we lose the 114s, I think we see 110s quick. And if we hold here, I think we can articulate back up to the 118s. That was sort of where this breakdown took place. So that's what I'm anticipating. Oh, the expected move this week is $4.41. That basically takes you up to 120.15 or down to 113.34. The Qs. So the Qs are breaking the old reference high. There's some good news and some bad news with the Qs. Let's first talk about the bad news. The bad news is we didn't hold this area. The bad news is we didn't hold the 100 MA. The good news is that there is a trend line, a rising 200-day moving average, and a very key breakout area where this kind of took off from. You have a 61.8 down at 108s. So as we steamroll down into this level, I'm interested in selling out of the money puts, maybe the 104s. If you go from this entire range, this 61.8 and this gap fill and these reference lows and the edge of this volume distribution all come into play around 204s. It's also the backside of this kind of regression line. So I think that this area, as we come down, if this doesn't hold into the 110s, I think that that would come down to here. But as we come into the 110s, as we come into the 108s to 110s, I like selling out of the money 104s down to 102s. Yeah, or playing put spreads or ratios. If this were to snap, we fill up that triangle, I think that's where we would be headed. That would not be very good for the market. You could also see that this box low, and I'm big into the box lows, is around 99.36. I don't know if we're going to fully articulate into there, but midway into this box here, look at this low, roughly around 105s. Remember what we were talking about, this range, 105s, 104s. I like the idea of selling those near-dated out-of-the-money puts as we come into this kind of 200 MA, 50% fib of this leg. So yeah, expected move this week is $3.79-ish, 117.44s or 109.86s. So that's consistent with what I was talking about. So if that comes down into there, this breakout area in the 109s to 111s, I want to start selling some out of the money near dated puts and for sure covering shorts. That area to me will likely be some support. Apple. Wow, we're really used up a lot of time already. So let's try and pick up the pace. The Apple. We lost the 50 MA. We lost the channel. This is likely going to fill the gap here to 105s. You have a 200 MA down in 103s. 103.74 to 100 has been in a key range. I currently have some put ratios on. I have 105s to 102s, and the break even is roughly 98s. The big gap fill is 96s. That would be a channel move. I am fine being long below $100 at least initially, because this would have traversed so far so fast. It to me would be a screaming buy anywhere near that gap fill. So I'd be looking to actually start legging out of the long part of that put spread and keeping the short part, and maybe even selling more out of the money puts, starting to get to the oversold regions. But anything below 109.85 to 111s is vulnerable. If this can get back up above 111s, 112s, I would construe this as a look below and fail. But this to me seems like it's going to fill the gap to 105s. That's just my thinking. Microsoft broke out. Again, came up from the bottom, got the .com high, just missed my 1.618 fib extension. I do think that this will eventually see the channel high, but I don't know that we aren't going to go lower first. So, like in FedEx, we may come back down, get a breakout retest, which we're kind of getting here. It looks like it's starting to hold. As this kind of fills the gap, I like the idea of selling some out of the money puts, maybe some 53s. That's the 61.8 of this range. If this were to get a 61.8 of the entire range, that takes you down to 47s. That is really the edge of the volume distribution. So that's going to really depend on the market. I don't really anticipate this completely falling apart that fast. But yeah, I think 53 out of the money, that's really this gap fill. So maybe we fill this gap and this gap if the market gets real squirrely. So as we kind of come into here, I'd have to see what the premium is like. But with the VIX being as high as it is, I like the idea of starting a position with starting to sell some out of the money 53 puts. Yeah, that's the deal with the softy. Amazon. So I kind of teased this one up a little bit. I have way too much time on my hands with Amazon, because I really want to buy this one. Again, I talked about selling at 833s. I never looked back. This really got a little higher, but if you sold up there, you're a happy camper. That was the 1.618 fib of this extension projected higher to the 833s. It got a little bit above, as this often does, but look what happened the last time we had one of these prolonged comparable moves up. This was like 400 and something points. This was roughly that, a little less. When you gap below the 50, you had a 148-point move lower. Then you had a 90-point bounce higher, and then resumed lower for a grand total of 222 points to this channel low. Depending where you draw the channel low from, if you use this more conservative line or this more aggressive line, and either one of them, really, I could make the argument is correct. The first leg down, meaning this one, would roughly take you to the breakout, which was 696.44. It would be 698.90. That's also the 200 MA. We lost the 50. We lost the 100. You know what that means, I think, 200s. I don't know that it's going to be a straight line, but I think we are coming down into this region. that would be a area to sell some out of the money puts, or to even buy the stock for a right or right out trade somewhere in this region. If this were to come down to the trend, that's a 50% fib. That's 660. I like the idea of starting to sell some out of the near dated out of the money puts into this region. If this continues, like we get the bounce and then comes down, that would take you roughly to 624, and the 61.8 of this entire range, which to me, you have a gap fill, just a lower at 602. You have a big breakout at 558. That would be 616. So as we would come down into that region, more like starting into here, I would be looking to sell those 558 out of the money puts, because I think that area somewhere between 558 and 616 is going to be where this bottoms. Just my thinking. So yeah, I'm looking for a bit of a move down here. Maybe start selling some out of the money puts. Maybe you get the bounce. But somewhere into this region is where I think we're going. This could be one potential bottom, and this would be the other, near that big gap fill down in the lower 600s. So that's what I'm thinking with regard to Amazon. If it does get back up over the 100 MA, it may want to get a 50 MA retest. You can see, look, when this broke down, it almost got the 50 and then resumed the trend lower. So I think 50 MA is a good re-short point. Or if you've missed the short, if there were a bounce to the 50 or close to the 50, it's a good idea to start selling some out of the money puts, because I do think we are going to get one of these channel lows tested. I don't know which one, but I do think one of them will be checked. I talked about BABA, I think. Did I? Yeah, I think I talked about it at the FXI, so we don't need to get into that again. Facebook. There was a lot of put activity in the Facebook. So there's some good news and there's some bad news. The good news is we avoided this one. I talked about getting out of this thing up near the 1.618 Fibonacci extension. It again got a little bit above, but now we are below trend and we are into the old breakout region. I think as long as this, I think the after hours low is 116 and change. You're still above the 200 MA. You're coming close to a 50 and 61.8 fib. So yeah, this area needs to hold between the 117s and the 121s, let's say 120s. So if this can hold in this area, it will be okay and probably fill the gap. The bad news is that we couldn't go higher on what was considered a good quarter, and they lowered their kind of guidance going forward. So numbers may need to come down. And it's been a while since Facebook has missed, but when they do miss, they stock, and with the current market we have, tends to go lower. So if this snapped the triangle here, we may want to start filling up. And I don't want to freak anyone out, but we could really get back down to the 108 to 110 area. That was really where this breakout was. So yeah, we need to hold in this like 117 to 120. If that loses there, then I think we're coming down more. Measured move would take you to the 113s. I would be interested in selling the 108, 110 puts, but we could always do a put spread, meaning buy something in here, selling 2 times out of the money here. I'm sorry, that's a put ratio. Or just doing an outright short, put spread buying like here and selling out of the money here. Preferably on a bounce day, maybe to the 100 MA. Anyway, we lost the 50. We're below the 100. That means we get a 200 MA test. So right or right out in 117s. That was roughly 116s, 117s. That was the after hours low. If you're trying to play for a bounce, if you lose there, I think it's a hard stopperooski. The Goog. Wow, this was just something else, right? Good quarter. This looked like it was going higher. You have now multiple days of selling, pretty much close to the gap fill. So the Goog should have been, I think, a little bit stronger. We did hold the 100 MA on the close, so maybe there is a bounce to the 50, but anything that's back below the 100, I'm thinking 200 MA. the 50% fib. That would basically be the gap fill in here. So if we get close to the 200, I'm interested in maybe selling some out of the money puts, the 736s or below. That's the 61.8. I think somewhere between this 50 and 61.8 will hold. If we get above this high of day, like these two high of days here on Monday or like Tuesday or whenever, above 790, I think this will retest to the breakdown near the 800 and the 50 MA. But this really would need to, like if we held the 100, we get the retest to the 50. Multiple holds, the breakdown, I think that this would be an area to reshort, unfortunately. Until you get back up above 110, this stock to me looks a little vulnerable. Down here, though, back of the old downtrend line, 61.8, that to me starts getting interested for out of the money put sales. So that's the Google. Netflix ran hard, bottom of the range to the top of the range, pulling back. Reference highs. The market hasn't been behaving well. Maybe, I don't know. I don't know if it fully fills the gap, but I do think it could get down to the 110, 108 area if we start losing these lows. I'm just sort of thinking that this is going to drift. It should do better. It's the only Momo name that really went up on earnings. It started the move. But if you do a Fibonacci retracement, the breakout level here was down at 106s. Maybe this just bleeds. I don't know. I think that the move has been had, kind of, so to speak, to the upside. And I think it was a good idea to take profits, which I had discussed. And now I'm thinking to either play with a put ratio, meaning like buy these puts, sell 2 times out of the money here, or waiting till it comes down there and then kind of selling some puts. PayPal, also one that was up big on earnings but has since not been performing. We basically are filling this gap. The 50 MA to me is very key. If you draw a 61.8, depending where, if you draw a fib, depending on where if you do the whole move or if you do it just from the last leg, this area here between 39s and 41s is key. Anything below 41, 49, really 41 to me gets more vulnerable, but they had a really good quarter. I eventually think that this stock is going to go much higher, but below 41 is a little troubling, to say the least. I do think that this will eventually see the 46s. It may even see the 44s first, but we ran here, had this consolidation and pullback to the 50 MA. 50 MA is key, so I like it long right against the 50 MA, or a stop out, and that would to me be a play down to the 100 MA, maybe a put ratio, like buying these puts, selling 2 times out of the money here. You have the 100 and the 200 down roughly in the 38s to 39s. I think that reference low would hold. I'd be an interested buyer, so it's a game of inches with that one. I think it's going to be a buy soon. AMBC. This is one that I had proposed a while back for a rounded bottom play. It had run into the number here. I got out. It's pulled back, and then I was selling some out of the money puts. It held the 100 MA. If we lose 50, we get 100. But if we hold 100, now we're above. I like it. Maybe this fills the gap to the 22s. But AMBC, my theory here is it broke the downtrend line. It's done a lot right. If you don't know what AMBC is, they are for companies that don't have the best credit rating, and then they pay AMBC for their credit rating. So like if you have a B bond and you want to get AAA status, you pay AMBC and you use their street cred, so to speak, to get your bond rating up. And with my theory is that if interest rates are rising and we're still kind of near the historical low, that companies would want to take advantage of this to issue debt. So they had a good quarter. Clearly they did well. It doesn't say what the estimate was, but the actual was pretty good. This multiple days down, gap up. This is looking to me a little bit professional gapish. Anything above this 120.19 should continue up to those 22s. So yeah, I'm still long. I actually added a little bit more. Be a little bit careful because this could be a one-day wonder, but I do like that this is kind of pressing up, and they had a good quarter, so I like the idea of buying the dips. Silliness stocks, and we'll end on silliness. I actually was short some puts in Fitbit, and I was thinking to hold them. I started looking at the put positions, and I started looking at how the stock was behaving, and unfortunately, I've seen this story before, where it just can't rally ahead of the number, and then that there's this big gap down. And I didn't really want to make a stand in Fitbit. So I took the puts off for about a 40-cent loss. It's all right. I've been very bearish and have made some bones on this stock in the past, so whatever, no biggie. Anyway, this stock had a huge gap down and is not doing well. Their management seems very out of touch. They thought that they were doing well with the Amazon sales. I will say this, the space has become commoditized. Fitbit makes a hell of a great product. I'm actually wearing one right now and was considering upgrading one. I actually wound up getting the new Apple Watch. I was waiting for them to come out with a waterproof watch. I not really needing that waterproofing all that much, but I wanted it nonetheless. I still may even get the Fitbit as a alternative secondary Fitbit thing. The new Charge 2 is particularly nice, although I wish you would be able to store and anyway, whatever. This stock is key. You have 2-day lows. I think that if you do a measured move, I think I calculated that coming down into like 665-ish area. So I'd be interested in buying this in the sixes or back up above 917 for a fill to the 11, like this area, 1165 to 1190s, the real breakdown reference area. That's where this edge of this volume distribution plays. So over the 2-day high, I like long. Below the 2-day low, I like short for another couple of bucks. So, yeah, that's what I'm thinking with Fitbit. GoPro. So this is one I've not liked for a while. I've hated this stock actually. I hate the management. I hate the company. I hate the product. I hate everything about it. Why do I hate it? Because it just reminds me of another product that was out years ago called the Flip camera that Cisco bought for $600 million. I think was it $600 million? Wound up being a zero. Everyone has iPhones. No one needs a action sports camera. There's only so many people jumping out of planes and riding bikes down mountains, and these cameras are really expensive. There's no upgrade cycle. They're very commoditized. They have tons of Chinese competition. You could buy these for like below $200 as opposed to $400 or $600. They can't get their drones out on time. I did think that they would have a decent holiday quarter just because they had no new product last Christmas, so I thought that they'd have an easier fourth quarter. That still may play out, so this stock to me could be on some borrowed time. The reason this bounced into the close was because Amazon has not been selling their products. They had some kind of dispute with Amazon, and I think the news came out that Amazon is going to resume selling, so the stock kind of filled the gap. However, it closed considerably lower. 200 MA here to me is key, and you have these 2-day highs. So if you can get back up above the 200 MA, I like it long for a bounce for that new product cycle for the fourth quarter. But in general, this stock to me looks like it may want to re-kiss the lows in the 8s. A lot of people like to buy that to fill up that triangle. It may even punch lower, kind of like its brethren in Fitbit. So just be careful. Anything below, look where the bounce stopped at the 200 MA. So we'll keep it simple. Anything over these 2-day high days, this was 1260. I like long for a move back up, maybe to the upper teens, but anywhere below there to me still could remain short or just stay away, right? TWLO. This is very quickly becoming Silliness Part 2. Now, I don't like to be an I told you so, although anyone who really knows me knows I love to be an I told you so, but for the purposes of this video, I know a lot of people got burned on this, and those are mostly... I know, first of all, I don't really want to say that. I want to say I know a lot of people made a lot of money on this based on my calls and play, and then I know a lot of people got cute and then gave it all back or even are down money now. Let's talk about what happened, how to avoid this in the future, and how to profit from it. This stock had a range. This was the breakout here, right? This was the consolidation pullback, and I said that this stock would get to 2 times range. It got it. It had a very violent pullback, it somehow eclipsed the high and got even higher, and then they started with the secondaries, and this stock completely is destroyed. This is kind of the point where you need to pull the ripcord. I've seen this game before. The double the range is always the play once you break through kind of the IPO high and the consolidation high, and then you never look back. A lot of people gave me a very hard time up here. I have not heard from a single one of them down here. Yeah. They did a secondary again now at 40. It broke that. I said that somewhere between 40 and 37s were the must hold. It did not. You are below the 78.6. You are probably going to come down somewhere in this IPO range between 27s and 23s, and maybe this even continues lower. All they're going to do is continue to issue stock. This was a sliver deal. There was very little supply, and once they did the secondary here and then again here, the stock is not reacting well. It's also not a really good market for a stock like a TWLO. This was their earnings day, so if this is going to bottom, if you can get like Monday above or Tuesday above 35.20, I like it for a right or right out long for a move for $5 up to 40. Anything below the low of day, 31.50, is going to continue lower in my view. So that's how to trade TWLO. This is how to avoid these, and this is how to profit from and to avoid them from in the past. The example I give for this, and I'm not really an overly crazy religious guy, is the story of Sodom and Gomorrah. And when Lot's wife looks back, Edith, whatever, looks back, and she gets turned to stone. If you looked back after this, you may have had a brief reprieve, but you're not a happy camper now. And I don't mean to rub that in anyone's faces or what have you. This is just how these stocks are. They burn very bright, but bright stars burn out the fastest, and that's the story with TWLO. Anyhow, we're well over an hour here, and that's my story. I'm sticking to it. Let's have a great week. I'm looking for I'm hoping that Monday isn't a bounce. I hope it's down, and I hope we're down into the election, and then we get the relief rally afterward. That, to me, would be the best scenario on no matter who wins. If we're up on Monday, it gets a little bit more iffy. The market, though, is down a lot into some reference levels. I think it could potentially go a bit lower, but I don't think a hell of a lot lower. SPY, I think between 203 to 206 is going to be the area to scoop them. So that's my story. I'm sticking to it. I will do a Periscope after the election, probably on Wednesday. Let's have a great week, and cheers.